Okay, good day everyone, and welcome to Module 14 of Financial Accounting and Reporting, FARS. Module 14 focuses upon investments. Now, when we talk about investments, we're talking about one company acquiring either the debt or the equity of another company. So our goal when we're talking about investments is how does the acquirer or the investor account for its investment in the acquiree or the investee? Okay, so listen, we have an investor or an acquirer who purchases the debt or the equity securities from the investee or the acquiree. So let's just make sure we get this terminology straight. So to begin with, let's turn to page 567 in Module 14. Now the approach I'm going to take is this. I'm going to go through point out the basic information that's most important in this module, and then I'm going to do problems to illustrate how this information, how these concepts, principles, and calculations are going to be tested. So again, I'll go through the first part of the conceptual information, then I'll do the questions at the end, including a simulation. So let's get going. 567. Investments in debt and equity securities are accounted for by the following standards: FASB 115, APB 18, and FASB 159. Now here's the most important part. The accounting treatment for investments is different depending upon the percentage ownership, the classification of the security, and the election of fair value option for reporting financial assets. So the point of this module is to cover the rules under FASB 115 for trading, available for sale, and held to maturity securities. Then the equity method of accounting, which is covered under the rule APB 18, will be covered. And the equity method is for investments in which the investor has significant influence over the investee. Okay? So here's where we're going to go with this. So let's start at point A, concepts of accounting and investment percentage. Okay, debt securities are covered by FASB 115. A debt security is defined as any security representing a creditor relationship with an enterprise. So this includes corporate bonds, convertible bonds, U.S. Treasury bonds, municipal securities, redeemable preferred stock, commercial paper, and other secured debt instruments. Okay? Now excluded from this category are unsecured trade receivables, consumer loans, notes receivables, etc. Point. As FASB 115 requires that investments in debt securities be classified in three categories: trading securities, available for sale securities, and held to maturity securities. So that is the way the investor is going to classify its investment in the debt securities of the investee. It's going to classify them in one of three categories: trading securities, available for sale securities, or held to maturity. Okay, now let's go to equity. Equity securities include ownership interests, so common stock, non-redeemable preferred stock, are classified as equity securities. I'm on number 2. The accounting rules for investments in the common stock of another corporation are generally based on the percentage of the voting stock owned. So, investments of less than 20% of the outstanding stock. So, if the investor acquires less than 20% of the outstanding shares of the investee, then the investor is assumed that it's assumed that the investor cannot exert significant influence on the investee. All right, next sentence. At 20% or more ownership, the investor is presumed to be able to significantly influence the operating and/or financial decisions of the investee. Most investments in this range will result in significant influence. However, the 20% level is just a guide. Okay? So, let me just show you this on the board. When we talk about equity investments, we have three classifications. When ownership, and I'm going to get a better pen, when ownership is less than 20%, when ownership is greater than 20% and less than or equal to 50%, and when ownership is greater than, so here's 2, here's 1, and here's 3. When ownership is greater than 50%. Now, we're not going to talk about ownership greater than 50% because that's consolidation. That's when if an investor owns more than 50% of an investee's outstanding stock, that's referred to as control. The investor has control over the investee, and we're going to talk about that in another module. But for this module, Module 14, we're going to focus upon the following two circumstances. When the investor owns less than 20%, and when the investor owns more than 20%, and in which case that's established for significant influence. Now, again, as the book points out, that 20% guideline is just that, it's a guideline. So oftentimes, an equity investor may own more than 20%, but is unable to exert significant influence over the investee. At other times, the investor may own less than 20%, but may still be able to exert significant influence over the investee. So when you are answering problems at the end of the chapter or on the exam, you must look for not only the percentage ownership, but you also must look out for this term, excuse me, significant influence. Okay. So now, let's go to Part C, and Part C, again, on page 567, investments of more than 50% of the outstanding stock. Now, this is what I said to you before. At more than 50% ownership, the investor has control because of its majority ownership of the voting stock. Most of these investments will require the preparation of consolidated financial statements, and consolidations are discussed in Module 16. So we're not going to focus upon over 50% ownership in this particular module. Okay, let's go to number 3. Securities, and when we talk about securities in this context, we mean both debt and equity securities, are originally recorded at cost, including any broker's fees, taxes, etc. This amount is the best estimate of fair value at acquisition. Cost equals the cash paid, or in non-cash transactions, the fair value of either the securities received or the resources sacrificed, whichever is more clearly determinable. The fair value of debt securities equals the present value of their future cash inflows. The present value is calculated using the current market rate of interest for similar investments with similar risk. Any accrued interest is accounted for separately. The fair value of equity securities to be marked to market must be readily determinable from quotes obtainable from a securities exchange registered with the Securities and Exchange Commission, that's what SEC stands for, or from the over-the-counter market. Investments which are considered to be non-tradable, or investments which do not have determinable market values, should be carried at cost and adjusted only for permanent declines. So, there's exhibit on at the top of page 568, which gives you a great presentation of how to account for equity securities. Let me also point out to you that in your packet there is a handout entitled Module 14, which should be on page 43 of the handout. And it talks about how securities are classified into the three different categories: held to maturity, available for sale, and trading, and then how the accounting is done for the securities that are classified in either of these three categories. Okay, so now I'm on page 568, Part B. It says investments in which significant influence does not exist. So again, we're still talking about equity securities, because only when you own an equity security can you even potentially exert any influence over the investee. Because remember, when you invest in a debt security, you're merely the creditor of the other corporation, not an owner in that corporation's equity. Okay? Part B, investments which do not confer significant influence over the operating or financial decisions of the investee consist of all debt securities and generally all small, less than 20% investments in equity securities. FASB 115 dictates that such investments be segregated into held-to-maturity securities, debt securities only, trading securities, and available for sale securities. Okay, so let's go over this. Now, here is debt securities. Debt is going to be classified into one of three categories: held to maturity, available for sale, trading. Okay, this is debt. Now, for equity securities, and again, we're talking about investments in equity securities of less than 20%. We're going to classify them also as available for sale, this is debt here, or trading. Okay? So, debt has three categories. Equity of less than 20% only has two categories. But one of the things I want to bring to your attention is both debt and equity in these two categories are treated in the same way. So the accounting treatment for both debt and equity securities classified as available for sale, or debt or equity securities classified as trading, is the same. Only debt can be classified in this category. All right, so let's go back to the book, page 567. Held to maturity securities, amortized costs. This category includes all debt securities and requires, this is very important, the positive intent and ability to hold the securities to maturity, not simply an absence of intent to sell. So what does this mean? So I am an investor, and I purchase the debt securities of another company. Now, I can classify my investment in these debt securities in one of these three categories. However, The only way that I can classify my investment in this other company's debt securities as held to maturity is if I have the positive, I as the investor have the positive intent and ability to hold these debt securities until they mature. Maturity may be 5 years from now, could be 10 years from now, or whatever, but in order for me to classify my investment in this other company's debt securities held to maturity, I must have a positive intent and ability to hold them to maturity. Okay, so let's go back to page 568, read about held to maturity. It says held to maturity securities are carried at amortized cost. What do we mean by amortized cost? It's acquisition cost adjusted for the amortization of premium or discount using the effective interest method. Thus, unrealized holding gains and losses are not reported. Okay? Very important. When we use this classification for held to maturity securities, they are always carried on the balance sheet at amortized cost. We do not recognize any unrealized changes in the value of these securities from one balance sheet date to another balance sheet date. That's what they mean by they do not. No unrealized holding gains and losses are reported. Okay, but realized gains and losses are included in earnings, as are interest income and premium and discount amortization. These securities, held to maturity securities, are classified on the balance sheet as either current or non-current on an individual basis, and on the statement of cash flows as investing activities. In rare circumstances, the investor company's intent to hold a security to maturity may change without casting doubt on its intent to hold other debt securities to maturity. The circumstances must be non-recurring and unforeseeable, and so something must have occurred which will cause premature sale of held to maturity securities. Okay? Now, again, investments in held to maturity securities are accounted for under the cost method, which requires that they be carried at amortized cost, acquisition costs adjusted for amortization of premium or discount. Right? Very important. Now, let's go to 2. Trading securities. They use the term mark to market. Remember that term. Debt and equity securities purchased and held principally for the purpose of generating gains on current resale are classified as trading securities. Okay, so I buy a debt or equity security, and when I classify it as a trading security, it means that I intend to resell it in a relatively short amount of time and benefit from a change in the fair value of this security. So you know the expression buy low, sell high. So I'm buying this debt or these equity securities at one price, expecting them to rise in price over a short period of time so that I can sell them and benefit from this price increase. Okay, so again, back at the bottom of 568. Trading securities are accounted for according to the cost adjusted for fair value method, mark to market, under which the carrying amount is adjusted at financial statement dates for subsequent changes in fair value. Okay? Trading securities are generally held by brokers, banks, and other financial institutions which engage in active buying and selling activities. Both unrealized and realized gains and losses are included in income. Very, very important. So, let me just say this. Held to maturity, no unrealized gains and losses are reported. Only realized gains and losses. Can you see that? All right. Now, trading securities, on the other hand, unrealized gains and losses are reported in income. As well as realized gains and losses. Okay, so again, let's continue reading. As I said, I'm on page 568, both unrealized and realized gains and losses are included in income. However, to the extent that realized gains and losses have been previously reported as unrealized, only changes in the current period shall be reported as realized in the period of sale. All right, let me explain what this means. All right, so let's suppose I have one trading security. I purchase it on November 12th, 2007 for $50 per share. Okay? Now, let's suppose that on December 31st, 2007, the price of this trading security is $70 per share. So what I'm going to do, and so here's the example. Let me give you the journal entry. First of all, I debit trading security for $50. I credit cash for $50. Now, let's suppose that on December 31st, 2007, the price of this security is now $70 per share. Well, because this is a trading security, I have to market this security on my balance sheet. That means that instead of listing this trading security at its original cost, I now have to list this trading security at its market value as of the end of the year. So because the price of this security has risen, this is the journal entry I'm going to make. I'm going to debit trading security for $20. And then I'm going to credit unrealized gain, unrealized holding gain, $20. Okay, so here's the T account. Originally, on November 12th, the balance in this account is $50. Well, after I make this entry of $20 on December 31st, the balance in this account is going to be $70, reflecting the market value of this security as of December 31st, 2007. Now, let's suppose that on January 15th, 2008, I sell this security, for $80 per share. Okay? Now, this is the journal entry that I'm going to make, and this is to pick up from what was said in the book. It says, trading both unrealized and realized gains and losses are included in income. So this $20 gain would be included in income in 2007. However, to the extent that realized gains and losses have been previously reported as unrealized, Only changes in the current period shall be reported as realized in the period of sale. Okay, so now I sell this security on January 15th for $80. Now, the total gain on my investment in this security is the difference between what I originally paid, $50, and the $80, which is $30. However, in the previous year, I've already recorded $20 in my income as an unrealized gain. So the journal entry that I'm going to make on January 15th, 2008 is that I'm going to debit cash for $80. I'm going to credit my trading security for $70 because this is the value that it was listed at as of the end of the year. And then I'm going to credit realized gain for $10. Okay? All right. So, now let's look further down again at the bottom of 568. It says, other components of earnings include dividend and interest revenue. Dividends on equity securities are recognized as income when declared by the investee. However, if dividends received exceed cumulative earnings since acquisition, the excess is counted for as a liquidating dividend. And remember, we talked about liquidating dividends a little bit in the stockholders' equity module, module 13. Trading securities are reported on the balance sheet as current assets and on the statement of cash flows as operating activities. Okay? Flip the page. Let's go on. Let's go on to 569. Debt securities reported at fair value require special accounting treatment. The securities are to be carried at market value, while interest and amortization are to be calculated using the effective interest method. Therefore, any unrealized gain or loss is actually the difference between the fair value and the amortized cost. That is, the adjustment equals the change in fair value during the period plus premium amortization, decrease in book value, or minus the discount amortization, which is the increase in book value. So this is what I mean, or this is what they mean. Again, we're talking about debt securities classified as trading securities. So again, we always, because it's a trading security, we have to classify them at fair value or mark them up to fair value, and then we have to recognize any unrealized holding gains and losses. Now, what this paragraph says is that before we can recognize before we can determine the amount of unrealized holding gains and losses on debt securities, we have to adjust the value of these debt securities for up to their amortized cost. So we have to recognize any discount or any premium on these debt securities, and then once we've adjusted their amortized cost basis, we can then compare this adjusted amortized cost with their fair value as of the balance sheet date, and that's what's going to determine the unrealized holding gain and loss. All right? So, both the interest revenue and the unrealized holding gain or loss are included in current earnings. All right? Now, let's go to 3, available for sale. Now, it also says available for sale securities are treated, or the accounting treatment is for mark to market. Available for sale securities include debt and equity securities not categorized as either held to maturity or trading securities. So in general, available for sale securities, this classification is like a catch-all classification. If it's not held to maturity or if it's not trading, then it falls into available for sale. For example, a company such as a manufacturing firm may purchase securities to make use of its idle cash. These securities are not actively traded, nor will they necessarily be held to maturity. So, included in earnings are realized gains and losses, which include previously unrealized holding gains and losses, as well as dividend and interest income. Now, available for sale securities are accounted for according to the cost adjusted for fair value, mark-to-market method, in a very similar way to how we accounted for trading securities. However, this is the next paragraph. Unrealized gains and losses on available for sale debt and equity securities are calculated in the same manner. But these gains and losses are not recognized in income of the period. Instead, the changes in fair value during a period are reported as other comprehensive income, and the accumulated unrealized gains and loss on marketable securities account is presented as accumulated other comprehensive income in stockholders' equity. All right, so here's what I mean by this example. I'm going to use the same example as I did before for a trading security, but now I'm going to call it an available for sale security. Okay? So I'm going to erase this. All right, so now, instead of a trading security, I'm going to call this an available for sale. Available for sale security. So I purchase it for $50. I'm going to debit available for sale security for $50, credit cash for $50. The price of my security is $70. Now, here's what I'm going to do. I still have to market my available for sale security, but my $20 unrealized holding gain is going to be credited to other comprehensive income. So here's what I'm going to do. Available for sale, $50 as of 11/12. So I'm going to debit available for sale security for $20. I'm going to credit my unrealized holding gain for $20. Okay? But because this is an available for sale security, this unrealized holding gain of $20 does not appear in my income or on my income statement. Instead, this unrealized holding gain is included in my other comprehensive income. Okay? So now, I said that here's $20. Now, I said on January 15th, 2008, okay, here is my unrealized holding gain account, which is included as part of my stockholders' equity, All right, now, I said on January 15th, I sell my security for $80. Now, here's how I'm going to account for it. Because it's an available for sale security, I'm going to debit cash for $80. Now, what I'm going to do is I'm going to reverse or pull out the unrealized holding gain that I had previously recorded as part of stockholders' equity when I marked this available for sale security up to market. So I'm going to debit unrealized holding gain for $20. Then I'm going to credit available for sale security for $70 because that's the balance in the account from the last time I marked it to market. And then I'm going to credit realized gain for $30, which is the difference between what my original cost is for this available for sale security and what I eventually sell it for. Okay? So the key difference between a trading security and an available for sale security is that with the trading security, each year or each accounting period, we're recognizing unrealized holding gains and losses in income. Whereas with an available for sale security, any changes in fair value, any unrealized holding gains and losses are not reported in income. Instead, they're recognized as other comprehensive income. And then when the security is actually sold, the realized holding gain that appears in income really does represent the difference between our original purchase price and what we sold it for. Okay? All right, so they give you a very, very good comprehensive example on page 570. I would go through this example very, very carefully. Let's move on to transfers between categories on page 572. FASB 115 requires that the classification of securities be reviewed at each balance sheet date. Although a reclassification should be rare, a company may deem it necessary to transfer security from one category to another. Such transfers are accounted for at fair value, taking into consideration any unrealized holding gains and losses. So, for example, when a security is transferred from trading, any recognized unrealized holding gain or loss as of the date of transfer should not be reversed. Okay? So if you've previously recognized an unrealized holding gain or loss in income, you're not going to reverse this. On the other hand, if you, in a transfer from available for sale or another category into trading security category, unrealized holding gains and losses are recognized immediately. Held to maturity securities reclassified to available for sale must be restated to fair value. Any unrealized holding gain or loss that results is reported as accumulated other comprehensive income in stockholders' equity. However, transfers from held to maturity should be rare. Okay? Unrealized holding gain or loss on securities transferred to held to maturity from available for sale is also reported as accumulated other comprehensive income in stockholders' equity, but this gain or loss is then amortized over the remaining life of the security as an adjustment to yield. And I'll show you an example of this. Okay? Now, let's go to page 573, Part C. Part C talks about investments where significant influence does exist. So now we're talking about equity securities. Now we're talking about when an investor purchases, we use the guideline, more than 20% of the outstanding shares of the investee. So, APB 18 requires the use of the equity method when accounting for investments which give the investor the ability to exercise significant influence over the operating and financial policies of the investee. APB 18 assumes that ownership of 20% or more of the outstanding stock will result in that ability. Exceptions to the use of the equity method, i.e. the cost adjusted for fair value method, are related to an assessment of the investor's level of influence over the investee. So basically what they're saying is, yes, we're using this 20%, greater than 20% as the guideline, but you may find in the problems that significant influence can be exerted less than 20%, in which case you would still use the equity method, or the investor may own more than 20%, cannot exert significant influence. In that case, you would probably classify that investment as available for sale and treat it, as we've discussed earlier, for available for sale investments. Okay? So, number one, C1, cost adjusted for fair value. The cost adjusted for fair value and the equity methods differ in the treatment of the investment account and in the recognition of earnings from the investment. The cost adjusted for fair value, actually what we were using for available for sale and trading securities, first records the cost of the investment in the investment account. Income is recognized for dividends distributed from income of the investee earned since the date the investor acquired the stock. Any dividends distributed by the investee, again, which exceed the earnings, are classified as a liquidating dividend and as a return of capital. Okay, again, I'm on page 574. Under the cost adjusted for fair value method, equity securities must be adjusted for subsequent changes in market value, as we just discussed, and the unrealized holding gain or loss for the period equals the current fair value minus the previous period's fair value on the books. Now, with the equity method also begins with recording the cost of the investment in the investment account. But the two methods differ from this point. A basic concept of the equity method is the reciprocal relationship formed between the investment account on the investor's books and the book values of the net assets on the investee's books. As changes in the investee's net assets occur, earnings that result from earnings and dividends, the investor will recognize in the investment account the percentage of ownership share of these accounts. Another aspect of the equity method is the computation and accounting for the difference between the cost of the investment and the book value of the acquired assets at the investment date. Okay? Now, excess of cost over book value. So what they're really saying is, in some cases, a corporation may purchase 20% of the, or let's say 25% of the outstanding shares of the investee. But the price that the investor pays for this 20% of the investee may be greater than the book value of the investee's share. Okay, so why is this? Excess of cost over book value is generally attributable to excess of fair value over book value, when the fair values of the investee's assets are greater than their book values. And another reason why is because of goodwill. when the investee has high earnings potential for which the investee has paid more than the fair value of the other's net assets. Let me give you an example. Okay, here is the investee. Okay, so the book value of the investee's shares is $70 per share. Let's suppose that the investor purchases 25% of the investee at a price of $80 per share. So in this case, we have a $10 difference between the price that the investee pays the investor pays and the book value of the investee's shares. Well, why is that $10 difference? Well, the $10 difference could be because that the assets on the investee's books are understated, that the assets on the investee's books are not listed at fair value. It could also be that the reason why the investee's book value is $70 but the investor pays $80 is because the investor has high hopes about the future earnings potential of the investee. Okay, so now we have excess of book value over cost. So in number one, we had excess of cost over book value. Now we have excess of book value over cost. That means that the investor purchases 25% of the investee's shares for $60 when the book value of the shares is $70. Why would this happen? Well, in number two, it says that the book values of the net assets of the investee are greater than their fair values, and the cost of the investment is less than even the fair value of the investee's net assets. Sometimes this is referred to as negative goodwill. Okay, so in the middle of under this page, they give you an example in which a company purchased 20 shares of B's company's 100 shares of common stock for $25,000. Go over this example. Okay? Now, turn to page 575 at the top, the full equity method. Now, what happens is, under the full equity method, this level includes any necessary amortization or write-off of the differential between the investment cost and book value of the investment. This level also recognizes the effects of any intercompany transactions. So in most cases, we are going to be using the full equity method to account for our investments when either the price that the investee pays is greater than the book value of the shares, or when the price that the investee pays is less than the book value. We're going to be using this full equity method. So please read this example on page 575. It's quite clear about how the accounting treatment is done. And again, when I get to the problems at the end of the chapter, we're going to go through this very fully. So, bottom of page 575, look at this changes to or from the equity method. When an investor changes from the cost adjusted for fair value to the equity method, the investment account must be adjusted retroactively, and prior year's income and retained earnings must be retroactively restated. Okay? So, when you go from the cost adjusted for fair value to the equity method, it requires a retroactive restatement. Very key point. It also says a change to the equity method would be made if an investor made additional purchases of stock and, for the first time, is able to exert significant influence over the operating and financial decisions of the investee. Remember that APB 18 states that investments are 20% or more of the investee's outstanding stock carry the presumption that the investor has the ability to exercise significant influence. I'm on page 576, next paragraph. The retroactive change to the equity method requires a prior period adjustment for the difference in the investment account and retained earnings account between the amounts that were recognized in prior periods under the cost adjusted for fair value method and the amounts that would have been recognized if the equity method had been used. Okay, so read this example that's provided. Now, in the middle of the page, it says, when an investor discontinues using the equity method because of an inability to influence the investee's financial and operating policies, no retroactive adjustment is allowed. And an example of this would be a disposal of stock resulting in a decrease in the percentage of stock owned from more than 20% to less than 20%. The earnings or losses that relate to the shares retained by the investor that were previously recognized by the investor should remain as part of the carrying amount. However, if dividends received by the investor in subsequent periods exceed the investor's share of the investee's earnings, then the excess should be accounted for as a return of capital, i.e. as a liquidating dividend. Now, I think this T account at the bottom of page 576 really captures the accounting using the equity method. All right, so if it's an equity method investment, we're going to debit the account for original cost of the investment. We're going to debit the account for our percentage share of the investee's net income. We're going to debit this account for any amortization of excess of book value over cost. We're going to debit this account for any increase above significant influence as a retroactive adjustment. Look at the credits. When we're using the equity method, we credit the investment account for the percentage share of the investee's losses since acquisition. We credit it for the percentage share of dividends received. We credit it for any amortization of excess of cost over book value, and then we also credit it for any disposal or sales of investments in stock. Definitely keep this account in mind. All right, so let me go on and to 577 and point out E, the fair value option. Now, FASB 159, issued in February 2007, allows an entity or an investor to value its securities at fair value. A firm can elect the fair value option on an instrument-by-instrument basis. If the firm elects the fair value option for reporting available for sale or held to maturity securities, then the security is revalued to fair value, and any gain or loss, both unrealized as well as realized gain or loss, is reported in earnings for the period. Likewise, if the fair value option is elected for instruments that would otherwise be reported using the equity method, the securities again are revalued at fair value each period, and any unrealized holding gains or losses would be recorded in earnings for the period. Okay? Now, the fair value option can be elected on the date an investment is first recognized or when the investment no longer qualifies for fair value treatment under FASB 115 or APB 118. So know that. Real quickly, stock dividends and stock splits are not recorded as income by the investor. Key important point. One other thing on page 578, please look at cash surrender value. It's not really that big of an issue, but I know they're going to ask you one or two questions on this. So, the cash surrender value of life insurance policies represents a non-current investment when the company is the beneficiary rather than insured employees. So the entry to record insurance premiums that increase cash surrender value is a debit to cash surrender value, a credit to cash, and then that top debit to insurance expense is a plug number. Cash surrender value remains a non-current asset unless the company plans to cash in the policy within the next period. During the first few years of a policy, no cash surrender value may attach to the policy. During this period, the entire insurance premium would be an expense. In addition, any dividends received from the life insurance policy are not recorded as revenue, but instead are offset against insurance expense. So, in the research component for investments can be found in APB 18, FASB 115, as well as, they didn't mention it, but it's FASB 159. So know these. Therefore, so research component for investments can be found primarily APB 18, FASB 115. It should be noted, however, that when FASB 115 was released, the pronouncement for reporting comprehensive income did not exist. Therefore, FASB 130 amends FASB 115 and outlines which investment transactions affect comprehensive income. Remember, it's only securities, debt as well as equity securities, classified as available for sale, will we use other comprehensive income. Remember, we said that any unrealized holding gains or losses on available for sale securities are reported as other comprehensive income and then are reflected in stockholders' equity. Okay? So, here's the issue with this module. Page-wise, this module is not very long. However, content-wise, this module is very dense because we talk about accounting for we talk about the classification of investments, and remember, how you classify the investment initially is going to determine the subsequent accounting treatment for it. Key point. So it's the classification that determines how we are eventually going to account for this investment at each subsequent reporting date. So when I come back, I'm going to do a number of problems at the end of the Wiley chapter to really illustrate so many of the concepts, principles, and computations that I've covered all